Financial Market Part 4. Capital Market. As per SEBI, capital market is a market for long-term debt and equity shares. In this market, the capital funds comprising of both equity and debt are issued and traded. This also includes private placement of debt and equity as well as organized markets like stock exchange. One of the important functions of the capital market is to provide ease of transactions for both the investor and companies. Features of capital market. Following are the main features of the capital market. First, link between investors and borrowers. The capital market links investors with the borrowers of funds. It routes money from savers to entrepreneurial borrowers. Second, deals in medium and long-term investment. Capital market is a market where medium and long-term financial instruments are traded. Through this market, corporates, industrial organizations, financial institutions access long-term funds from both domestic and foreign markets. Third, presence of intermediaries. Capital market operates with the help of intermediaries like brokers, underwriters, merchant bankers, collection bankers, etc. These intermediaries are important elements of a capital market. Fourth, promotes capital formation. Capital market provides a platform for investors and borrowers of long-term funds to trade. This leads to capital formation in an economy as it mobilizes funds. Capital formation is the net addition to the existing stock of an economy's capital. Fifth, regulated by government rules, regulations, and policies. Capital market operates freely. However, it is regulated by government rules, regulations, and policies. E.g., SEBI is the regulator of capital markets. Sixth, deals in marketable and non-marketable securities. Capital market trades in both marketable and non-marketable securities. Marketable securities are securities that can be transferred, which is shares, debentures, etc. And non-marketable securities are those which cannot be transferred. Example, term deposits, loans, and advances. Seventh, variety of investors. Capital market has a wide variety of investors. It comprises both individuals like general public and institutional investors like mutual funds, insurance companies, financial institutions, etc. 8. Risk. Risk is very high here as the instruments have long maturity periods. However, the return on investment is very high. Instruments in capital market. Equity shares, preference shares, debentures, bonds, government securities and public deposits. Types of capital market. Capital market is mainly classified as government securities market or gilt-edged markets. In this market, government and semi-government securities are traded. Second, industrial securities market. In this market, industrial securities, which is shares and debentures of new or existing corporates, are traded. This market is further divided into a primary or new issues market. Here, companies sell fresh shares, debentures, etc. for the first time to the public. B. Secondary market. Here already existing shares, debentures, etc. are traded through the stock exchange. A. Primary market. In primary market, companies sell their shares, debentures, etc. for the first time to raise fresh capital. It exclusively deals with the issue of new securities. For example, securities that are issued to investors for the very first time. Hence, this market is also known as new issues market. The main function of the primary market is to facilitate capital formation. It is a place where investors can invest their surplus funds profitably and companies can raise capital easily. On the basis of type of funds raised, primary market can be classified as equity market and debt market. In equity market, securities like equity shares, preference shares, rights issue, etc. are issued. In debt market, debenture, bonds, fixed deposits, etc. are issued. Methods of raising funds in the primary market. First, IPO, initial public offer. Initial public offer refers to the process of offering shares of a company to the public for the first time. Investors can directly buy the securities from the issuing company. Second, FPO, further slash follow on public offer. When a company issues shares to the public after an initial public offer, it is called further slash follow on public offer. Third, rights issue. When a company is in need of additional funds, they can first collect it from their current investors by giving them an opportunity to buy the shares of the company. Such an issue of shares is called as right issue, as the existing shareholders are given the right to buy new shares before it is offered to the public. Fourth, private placement. Private placement means when a company offers its securities to a select group of persons identified by board, excluding qualified institutional buyers and employees. Example, financial institutions, banks, insurance companies, etc., not exceeding 200. The, this helps the company raise the funds efficiently, quickly, and economically. B. Secondary market. Secondary market is more commonly known as the stock market or the stock exchange. Here, the previously issued securities are bought and sold by the investors. After IPO, when the shares are listed at the stock exchange, they can be traded in the secondary market. In this market, the securities are traded between investors.